Housing prices are falling? Hey, this is Dave with the Bolduc Realty Group. Welcome to my weekly real estate market update. Today's May 12th. Happy Friday. Hope you got big plans for the weekend. I'm pretty excited. I'm heading up to Westover Air Force Base to see the air show tomorrow with my brother and my dad. It's going to be a great time. Before we jump into what's going on in the Connecticut real estate market, I'd like to just ask, please like, subscribe, ring the notification bell if you're getting value out of the content. And comments, questions are always appreciated. Try to answer them as quickly as I can. Moving into Connecticut key market stats, active on the market, 3,656 today, up from 3,651, a grand total of 5 higher than last week. So we are seeing some progress. That's a good thing, but we're definitely lower than we would like to see, and we're not really seeing that spring influx of listings that we were hoping for. April closings, 2,611. We're down about 300 from last month. That is what it is. So based on April sales, we're at about 1.4 months of inventory. So here's some key dates, that some coming up and some in the past. A couple of big inflation reports this week. CPI, that's what we pay in the store, for April was in line with expectations. So the market likes to see things happen as expected. So that's a good thing. Silver lining here, inflation is slowing down. Prices are still going up, not quite as fast. PPI, that's what producers pay for the raw materials and goods that they use. For April, it was lower than expected. That means that the prices that producers paid was less than what was forecast. So that's a good thing. Again, silver lining here is inflation is slowing down. Prices going up, not quite as fast as they were before. And in the case of the PPI, less than what was expected as well. So that's a good thing. Both good news reports. On the other side of the coin, the job market remains strong. We added a lot of jobs in April. We don't want to see anyone lose their job, but unfortunately, what the Fed is looking for right now is the job market to weaken, which will indicate that the economy is getting weaker. With continued strong job growth, the Fed could potentially raise rates again. Low chance, but it could happen. They will certainly not pivot and start loosening fiscal policy until they see a weakened job report and weaker economy. The risk of a recession increases. Some say we're already in it. How does this impact the housing market? Because that's the big question, right? Assuming rates go down based on this good news on the inflation report, more buyers are going to enter the market. That is going to increase demand at a time when inventory is not increasing. It's pretty flat. What's going to happen is prices are going to continue to climb. If mortgage rates stay flat, which they kind of have been, they really haven't moved too much, demand is higher than supply, which will continue to cause prices to creep up. Just as a note, from April of 2022 to April of 2023, housing prices went up 6% in Connecticut. I had predicted 2 to 3% at the beginning of the year, and so I was wrong there. If mortgage rates climb due to additional Fed action, the strong job report, something else, demand is going to decline. I think we can all agree on that. So far, high mortgages have not been able to push demand below the low supply that we have. I don't know how high those mortgage rates need to go to do that. Probably don't want to find out. It's certainly higher than the mortgage rates we have right now. To make my point, this chart here, which I've shown you before, shows the housing price changes in the last 6 recessions. Everybody always sees the standout, which was 2008. The market conditions varied in every single one of these recessions. The point I want to make here is, in 2008, the market conditions were extremely different than they are now. There was massive construction boom building up to it for housing. Inventory was very high, like 10x what it is now. Lending standards were extremely loose, and most people had little or no equity in their homes. Today, it's completely different. Basically the opposite. Very little construction going on, extreme low inventory, tight lending standards, and if you're a buyer, you know exactly what I'm talking about. And over 50% of homeowners have 50% or greater equity in their home. So if your home is worth $300,000 and you're one of those homeowners, you owe 150 or less and you have 150 or more in equity. So it's a very different position. The bottom line is the Connecticut real estate market remains a strong seller's market. Price appreciation is expected to continue throughout the year. Keep in mind, every market is different. Real estate is local. Real estate trends in California, Texas, Ohio, they're interesting, but they don't necessarily reflect what's happening in Connecticut. National news reports, they're talking about national averages or maybe the top 10 or 20 metro areas. The thing you need to understand is there are no Connecticut metro areas that are in the top 20. Hartford is 48, Bridgeport is 59, and New Haven is 69. Talking about the primary mortgage market survey. Mortgage rates eased, a little bit. They're down from 6.39 to 6.35. Rates seem to be holding in that mid 6% range. Jobs report was stronger than expected, but CPI and PPI came in favorable. Another interesting note is the recent trend in increases in jobless claims. Does that indicate that the job market's getting weaker, that the economy's getting weaker? I don't know, but there's good news and bad news if that is the case. The good news, the Fed is more likely to ease monetary policy, but it also means we're closer to or maybe farther into a recession. Let's hope for that fabled soft landing. That's what I have for today. Appreciate any comments or questions. They're always welcome. Have a great day.